for some more market trends, stocks to watch. David Stryzewski's with us, CEO at Sound Planning Group. What's your big picture? How are you feeling about this market right now? Good afternoon.
Hey, well, great to be with you, Nicole. I'm kind of thinking about this, and I think, what we've known over the last 40 years in our economy with, falling interest rates as we came out of this last inflation cycle and everything down each year, and then with a really strong middle class, I think a lot of those trends right now are changing, and I think it's very important for people to be aware of it. Why? Because real estate is a lagging indicator. And so we just had some fresh data out that says that, ultimately that this buying season has been the worst that we've seen in more than a decade. Why? Ultimately, affordability is at its worst place than it's ever been. And so that's a terrible idea for the average family out here, as we've gone from 3% mortgages now to 7% mortgages, and people are just not motivated to get out and sell right now. And so with this lower volume, we have seen these new homes come out. And what a lot of people are puzzled by is, well, hey, why is the price of the average house going up? And the reason for this is that we're buying brand new homes. And so if we're buying a brand new house, guess what? It's going to cost a little bit more than an older house that you just picked up from somebody else. But there's a lot of people out here today that are looking. I just don't think that they're going to be making moves until we probably get below like 5% on our mortgages. For people to really get out there and be motivated enough to buy and sell.
Yeah, I mean, look, home prices are still at fresh record highs. To your point, a lot of new homes have been the supply, but they have the ability to work with you on the mortgage rate, right? The home builders, and that's right. One of the reasons people like going there. That being said, what do you tell folks who want to make some money in the market? We've seen some rotation. What are you more geared towards these days?
Okay, well, a couple of things that I'll just note here is that, the world is changing. I think a lot of the data, if we're paying attention and not just looking at headline numbers, but we're kind of diving into the details, we see an erosion taking place right now. And I don't think that we're quite as strong as we think that we are. Although, hey, we get a bunch of liquidity in the market, it still could go up. So I think a lot of people are taking a play right out of Warren Buffett's book here today, and they're raising some cash. And the reason why we know this is because we're seeing volume spike right now in a lot of tech selling. And so, we're just taking profits, and this is normal. This is healthy. I expect, like a 5-10% pullback, and then it's probably going to be off to the races here, given the fact that we're in a presidential election year, et cetera, et cetera. So where should people go to allocate? Well, I think that there's a lot of rotation that's coming out of big tech, which is amazing, and I do still think it can run, especially some of the names out there. But I think that we're rotating into things like oil. That we recognize is becoming more expensive. We know that this is important. We see some of the dynamics changing right now with the BRICS nations and the fact that we're having to go around South America now. We can't just use these normal canals. It's just more expensive to get this stuff. I'm looking at metals and metal miners very specifically. I want to point out something, and that is, of course, gold is the ultimate hedge as it relates to uncertainty. A lot of people are looking at the world right now, and I think it's true, whether inflation's up or down, whether we have positive stock markets or negative stock markets. There's a number of factors that we can lay out. I think in pretty much every scenario, I can point to gold as being one of the biggest winners out of this. And when I talk about gold, I really want to mention silver. Why? Because everything's sitting here at its all-time highs right now, including gold. Did you know that silver is 40% below its all-time high of $50? It's sitting at about 30 right now. And so I believe that this is a gift. So there's a number of ways to play this gold-silver rally. I think miners are probably one of the better ways, because who knows when significant vertical spikes come. But ultimately, I got a couple of picks here for you, and they are Rio Tinto, which is the second largest mining company. And so, you want to talk about some of the big guys, why they've got buying power. And so there's acquisitions that are strategically being made right now as new demand is coming in. We've also got this higher base price, so it's more profitable. But this particular organization is doing like $54 billion a year. They've got great market exposure worldwide. They've got lithium involved, iron ore. I think that this should be a part of anyone's that's serious in a diversified portfolio. But I'm looking at individual names here. And then another one is Alamos Gold. If I'm talking about some of the names in here that I think have a really strong potential on the upside, we've got about 30 hedge funds right now that are looking at this and invested pretty significantly. They've made a significant acquisition here this year that has resulted in big upside. And of course, when you got the price going up, they're a lot more profitable right now. They're looking at another 15-16% on the year. And the previous name I just gave you is looking at about 25%. So we think that these are real ideas. My whole point here is get some exposure. I don't know what people want to do, and if they don't want to do individual names, maybe go to GDX or GDXJ. The big miners are just the small miners, but this is the time to get allocated today while they are not being valued, I think, in a way that is truly significant here as the world turns.
Yeah, and we were just talking about rates in the last segment, and that's something you're watching pertaining to housing overall, the inversion of the yield curve, which has been flattening some, right? So, David, tell me more about the rate environment and what that means for investors. Why does it matter?
All right. Well, everyone's looking for rate cuts. We have rallied, I think, 5-6 times now on this, rate cuts are coming. I think that they actually are now, and that's going to be really bullish for the market, at least for the short term. Although if we actually look at data, every time that the Fed kind of changes direction, and we're at the 1-year mark here, July 26th tomorrow, since they stopped, raising rates, when we see those pivots come, recessions follow pretty quickly afterwards. So I wouldn't get ahead of my skis here on all this, but I think that as we're looking at where the world is, there are a lot of companies here today, in specifically the Russell, that need lower rates like immediately. Why? Because they're having to borrow at a time right now that things are just much more expensive, and then now their prices to borrow have significantly increased. Liquidity is changing right now. And so if you are certain types of businesses or for certain types of projects, it's hard to get capital today. And that is a big challenge, because if you don't got the cash right now because you're too small, and you're not one of the big guys sitting on all of it, you don't got enough fuel to really grow in a way that I think is meaningful. And so I think that the rates are going to cut. I think that the average consumer is going to see some mortgage declines, at least for the short term. That is until I believe that we have more Treasury issuance when the issue comes and the challenge comes. And my base case here is unfortunately that I think the U.S. Treasury is going to be seen as less valuable in the future and potentially loses its world reserve asset status because of the excessive printing and spending and the high likelihood that Moody's is going to come in here and say deficit spending's too high, debt to GDP, we're slowing down, things are not clear as they were before, and so maybe that third rating agency downgrades us, and we find ourselves in a difficult spot. But, the U.S. is still the strongest place to be right now. So I'll put on the dirtiest shirt, or the cleanest shirt in the dirty laundry, I guess, and just say that the U.S. is still a good place to be, but we still have some issues. Let's allocate to some safer places.
David Stryzewski, thank you, of Sound Planning Group. Great to see you, David. Thanks.